Good morning. Good morning. Great Friday morning, I should say. Welcome to the Streets opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Friday. Yes, it is Friday. I can confirm, according to sources familiar with the situation, we made it to the end of the week. Today is the 23rd of September. I'm JD Durkin. Opening bell rung here on the floor of the NYSE just moments ago by the Nelson Mandela Foundation to honor Nelson Mandela's legacy. A quick check of the big board here, just a moment or two into the start of this trading session. Not a big surprise if you have been following the pre-market indicators before the opening bell a minute and a half ago. The Dow is opening down right now about 0.9 of a percentage point. That's a similar story for the S&P 500 as well as the tech-heavy NASDAQ. You know, that's the beauty of broadcasting from the floor of the stock exchange, is that whenever maybe you can't get the data pulled up on your computer, it's fine. There are big boards quite literally posted all over the floor to see what investors have in store. We'll continue to give you that information throughout this morning's show. Today's session could very well be the fourth negative session in a row. It certainly seems as if it may be across the major averages, which are on pace for their fifth decline in just the last 6 weeks. This week alone, the Dow has given up 2.4%, the S&P down 3%, the tech-heavy NASDAQ down 3.3%. Now let's take a look at what's on tap for this morning's broadcast. We are tracking the latest for investors after pre-market pointed to yet another notable sell-off. Goldman Sachs cutting its full-year target for the S&P. We'll tell you what you need to know, what it means for you, plus a look at just how hard of a hard landing we may be in for as recession risk rises. And finally, Apple taking a bite out of the Super Bowl halftime show, what it means for fans come February. For insights into those stories and so much more, we always include so much more. I literally can ask this man anything, and I've realized at this point he has the answers to everything. Let's now bring in our senior editor and chief markets correspondent, Mr. Martin Baccardax. Martin, good morning to you. Happy Friday. So if I'm not mistaken, the Dow first crossed 30K sometime around November of 2020, and it certainly seems as if, obviously, we know the volatility that has happened since then. Is it going to slide down to that level again today? What are your thoughts on that?
Well, we've taken out 30 grand here at the start, haven't we? And we're back down now to the lows that we touched in early June prior to that really odd summer rally that was driven to some extent by the assumption that the Fed was going to pause rate hikes. Seems like such a long time ago now, doesn't it? Because the rhetoric from the Fed, of course, is very indicative of faster rate hikes going forward, higher rates for a longer period of time, and then really just an unambiguous signaling on an inflation fight from the Fed chairman and his colleagues, all of whom seem to be singing off the same hymn sheet. So what we're seeing now is really, to some degree, what you might call a capitulation from equity investors and from risk investors around the world, JD. What they're saying is that inflation is not likely to slow to their liking in the coming months. Central banks are going to remain hawkish. That is going to blunt global growth. Those three combinations are nowhere close to the conditions that you need to generate earnings, and therefore you're going to dump stocks and risk assets, even the ones that you like, as a result. And that really is the prime definition of capitulation. We might not be there yet, but the fact that we have taken out those June lows tells me there's definitely weakness in the windscreen.
Now, without even realizing, of course, as soon as I asked the question, you're exactly right. That's where we sit. As we speak, 29,753. We will track those figures closely over the course of the show and, of course, throughout the day on TheStreet.com. Now, Jay Powell has tried to be very clear about his intentions. I guess he's tried to be clear. It certainly seems as if he has, right? He's been in lockstep. You hear Jay Powell at Jackson Hole a few weeks ago. You hear from Jay Powell again here earlier this week. The message hadn't changed a whole lot. Why is there a bit of a persistent fear, perhaps, among investors that the Fed is overdoing it, Martin?
Really, I think it points to the labor market, JD. If I had to look at one metric that most concerns people, essentially over the past 9 weeks, we haven't seen we've seen a consistent, although not week on week, increase in weekly unemployment applications. And that might suggest some weakness in the labor market, which to date has been underpinning the resilience of U.S. economic growth. Now, if the labor market were to weaken significantly, then we would absolutely be teeing up recession prospects here in the United States. The Fed itself said it likely sees unemployment rising to 4.4% at the end of next year. We're at 3.5% or so right now. That big change of 1% difference, a 1 point difference between now and the end of next year is almost entirely indicative of the kind of recession that people are now predicting. So I think the rhetoric combined with labor market weakness, and probably most importantly, JD, the movements that we're seeing in the bond market right now do suggest that investors are a lot more pessimistic about growth forecasts than they were even just a few weeks ago. And maybe you could argue that the rhetoric from Chairman Powell and his colleagues was an accelerant, but I think ultimately it was only a confirmation of the data points that we've been tracking now for a number of weeks.
Speaking of tracking, I know that you follow CME Group's FedWatch very closely. Based on what you've seen there, Martin, in the last day or so, what is the current likelihood? They usually give it a statistical probability of another 75 basis point rate hike come November.
Around 77% when I last checked it, JD, and that is astonishingly up from 0% at the end of August. That's how quickly things have changed in terms of forecasting rate hikes. So the fact that we're likely to go 4 consecutive meetings with 75 basis point rate hikes will only cement the case for really what is now the most aggressive central bank tightening in the United States that we've seen in several generations, and really probably arguably on record, because it's being paired by something that doesn't get talked about enough, JD, and that is the roll-off of Treasury bonds from the Fed's balance sheet. Go all the way back to the financial crisis in 2008 and the talk of quantitative easing. The Fed back then lowered rates to 0%. When you get that low, there's nothing you can do further in order to lower rates because you can't go below 0. What the Fed did was it began to buy up Treasury bonds in the marketplace. When the price goes up, the yield goes down. So not only were base rates at 0, but the Fed was trying to lower rates in the marketplace for Treasury bonds in order to entice investors into riskier portions of the market. That's essentially what quantitative easing does. Now, that was executed over a number of years and then accelerated in the middle part of the past decade. Collectively, the Fed's balance sheet grew to about $9 trillion at its peak as a result of all these purchases. They're going to be sold back into the marketplace now, JD, and the mechanics are exactly the same. In this case, the price for the bonds is going down because more are coming onto the market, and the yield is rising. So that's why you're seeing 2-year Treasury note yields at around 4.2%. That's the highest since 2007. And you're seeing the gap or the spread between 2-year and 10-year notes at about 45 basis points. It sounds a bit pointy-headed, but ultimately it means that investors are more worried about inflation in the long term, inflation in the short term and growth in the long term. When you have those dynamics in place, that is almost entirely the result of people being worried about about recession. The inverted yield curve is one of the most accurate predictors we have of recession, and it's been inverted for the longest time now, about 4 or 5 months, if I have my figures correct. So again, those are the mechanics that I'm seeing in the marketplace, and that's why I think you're seeing weakness in stocks and in other assets around the world.
Martin, if we're looking at a 77% likelihood or so of another 75 basis points, does the CME Group give an estimation of what makes up the rest of that percent? Is 50 on the table? Is 100 on the table? We talked about Wells Fargo earlier in the week that says, rip the Band-Aid off. Let's go 150 if that's what we need to do. Obviously, that's before we had the September meeting information. Yeah. What other possible numbers, even if it's a very small likelihood, are at least on the CME Group's radar, I wonder?
The balance is mostly to the 50 side, JD, and there really isn't anything that at least I saw this morning on the 100 side. I really think if you're looking at market reaction today and over the last 3 days to a 75 basis point rate hike, imagine the chaos we'd see if the Fed had actually gone 150 and done this absurd Band-Aid ripping strategy that Wells Fargo was talking about just a couple of days ago. We'd be looking at dislocation that would be far more painful than this. So I think ultimately those sort of extreme rate hike arguments have just fallen to the wayside now because economic growth indicators are weakening, and we're seeing the disruption in financial markets as a result of the, I wouldn't call it modest, but telegraphed tightening. If we were to get tightening that was untelegraphed in the form of 100 or 125 basis points, we'd be looking at declines on stocks right now that are even more significant than what we're seeing.
I wonder, is there any other notable October data points that you might be following? Obviously, we had a very hot inflation number came out a couple weeks ago. The debate was to what degree will that shift Fed Chair Jay Powell's thinking it all. And between now and the November meeting, is there any sets of data that you know, Martin, that will be released that you'll be very closely following that might shake or jostle Chair Powell off his position?
There's a handful of data in between now and the November decision, JD. I think the most significant are going to be the jobs figures that we'll get for September and October, both of which will come prior to the November meeting. We'll also get CPI on the 13th of October as well. That will be interesting to see whether the headline figure retreats a little bit from that hotter than expected August reading. There'll also be 2 readings of the PCE price index. That's the preferred gauge of the Fed in terms of its measuring inflation pressures in the U.S. economy. But again, to go back to the jobs, I really think that's probably the most significant, because the Fed is certainly worried that wage inflation is going to continue to drive consumer price pressures across the economy and increase the chances that they will become embedded. And that is exactly what the Fed does not want to see, because it's so much more difficult unraveling them if they do become so. Wages, they can rise, but they fall much more slowly because very few of us accept a pay cut, even though we're all very excited to get a pay rise. And when you get stories like Target adding 100,000 seasonal workers at between $17 and $24 an hour, you get Walmart adding 40,000, and you get hiring plans from other companies as well that are ramping up into the holiday season, you can see why the Fed would be worried about wage acceleration, particularly, JD. And this is a number that, again, I know we talk about, but it still remains astonishing to me at the very least. There are 11 million unfilled positions in the U.S. economy as of last month. That's near the highest on record. It really seems impossible to me that we have that many people who are prepared to sit out of the labor market when their wage, the leverage they have in wage negotiation, is the best it's been in 2 generations. If those workers come back, that might actually put downward pressure on wages, because companies might feel they have the upper hand. But at the moment, workers absolutely have the upper hand. You can see it in wage negotiations. You can see it in the expansion of union influence across some of the biggest companies in the United States. And you can see it in the monthly indications of average hourly earnings increases in those employment reports. So that's why I think the September and October numbers will be so important for the Fed when they make that decision in November.
I had a suspicion that was the right question to ask, because to be honest, I wasn't aware of all the data that you had been following. I was curious your perspective, and of course, you drilled it out of the ballpark, as you always do. That's a great answer and a great perspective. I think it gives viewers an accurate. Listen, a home run over a short porch, Martin, is still a home run on the score sheet at the end of the day, my friend. Absolutely. So very well done on that, and I do appreciate the perspective. I do want to talk about bond yields. Of course, they've been soaring. The 2-year Treasury note right now, obviously at a 15-year high. It's just north of 4%. In what ways is the bond market flashing warning signs of a recession? And I know we got briefly away from using that word, but after what we've seen the last couple of days, it really seems like recession concerns are back at the forefront, aren't they?
Yeah, they absolutely are. I think for the longest time, people looked at the bond market as more of a pure indication of economic prospects, for whatever reason, historical or otherwise. That's less the case now, JD, because I think price discovery is being sort of dislocated by the fact that the Fed is pouring new debt onto the marketplace as a result of its balance sheet runoff. Nonetheless, we always tend to look at the inversion of the yield curve, higher 2-year rates when compared to 10-year rates, as the most significant indicator of recession. However, probably the most important is what we don't always talk about, and that is the yield for 3-month Treasury bills and 10-year Treasury notes. And that seems a bit arcane, but nonetheless, it's an important metric nonetheless. If that were to invert, we would almost be lock certain for recession. At the moment, it is not. 10-year notes are trading at about 3.75%. 3-month Treasury bills are trading at 3.26%. So we have a little bit of ways to go before that inverts, but it is moving in the wrong direction for the bulls. So I do believe that the bond market is flashing those kind of warning concerns. And ultimately, they're really just caught in lock, sort of in between a rock and a hard place, in the sense that there is concern about near-term inflation. Inflation is the enemy of bonds, JD. It erodes the value of fixed income payments, and it makes them cheaper as a result, and therefore rates rise. So they're worried about inflation in the near term and growth in the long term, and that's why you're seeing the inversion, and that's why we're seeing the sell-off in stocks today.
Yeah, of course, time is such an important factor when you talk about bonds. I do want to ask you, let's turn our attention here now, if we can, to non-essentials, especially in a potential recessionary environment moving forward, and specifically consumer discretionary stocks. Those are among those perhaps most likely to take a really severe hit in a recession. A lot of American families, if you have to tighten your belt, especially with an increase in the federal benchmark rate, you may start to say, hey, maybe a year ago or so, I was able to go to that brick and mortar store. I was able to go to X company and spend a little bit of money. Now I can't. What should we be following in some of those names for the months ahead, specifically in consumer discretionary, Martin?
This is a really important one, JD, because I think it's going to speak to the sort of value consciousness that American consumers have going into the final months of the year. And that really puts a lot of emphasis on companies that have pricing power and those that are able to sort of maneuver their input price dynamics and therefore lay some of those costs, but not all of them, onto their customer base. So you're talking about grocery stores, you're talking about significant brand strength companies that are able to put food staples, for instance, in the processed and packaged food segment into the marketplace at higher prices. And you're going to want to come away from companies which have been more reliant on brand emphasis and experience as opposed to the practicalities. So in that sense, I would favor someone like Kroger over Beyond Meat. I would favor someone like Starbucks over, let's say, a company such as, I'm actually losing my train of thought in comparison, but you see the point that I'm making. Companies that have that pricing power are going to do better than those that do not. And I think that will ultimately explain why and how the consumer discretionary dollar will be spent over the coming years. But what we are also seeing, JD, is an interesting circuit breaker, if you will, in the global market today. Oil prices fell below the $80 mark here in the United States this morning for the first time since January. That's going to pull gasoline prices further down. They've been declining for about 14 weeks, and they're still higher than they were last year. But the prognosis is that they will fall below $3 a gallon before the end of the year. That will free up a significant amount of spending for American consumers that were previously putting it into their gas tanks and can now put it to work into the consumer-driven economy heading into the holiday season. So I think that might be a sort of what's the term I'm searching for here? A check and balance, if you will, a balance on the fact that people are having to pull back in other portions of the economy. They will be given a bit of a boost as a result of the decline in gas prices.
Well, speaking of checks and balances, not that this is a politics show, but we are 46 days out from the midterms. And for the very loud chorus of criticism that came from Republicans against the incumbency, which is the president, Joe Biden, and Democrats in Congress over gas prices, I have started to notice a little bit of, dare I say, sort of social media swag from the White House. They've been very quick to spike the football here in the last couple of days with regards to petroleum or gas prices specifically. Do you expect that to continue, at least in terms of the optics and the politics of Democrats in Washington saying, hey, now take a look at what has happened for falling gas prices? We've had all these weeks where suddenly the conversation is at least a little bit different as we inch closer to November.
If I were a person of faith, JD, and I were a member of the Democratic Party, I would be saying prayers for the kind of inflation reading that would see a decline in headline consumer prices. Because if you can get sliding inflation heading into the midterms in concert with declining gas prices, then you would have a platform from which you could argue that the economy is ready for some kind of turnaround, or at least the ability to avoid recession. So I think whilst gas prices will be absolutely a strong sort of a talking point for Democratic lawmakers who are going out onto the stump against their rivals, it will have to be matched by slowing inflation. And that's why I think you have to have your fingers crossed and your prayers said to see those numbers come down, because the Republicans will use, and I'm not saying they're absolutely wrong, the politics is a rough and tumble game, they will say that the extra spending and the stimulus that was executed by the Biden administration stoked inflation pressures. And therefore, they will use that argument against Democrats who say the economy is turning because of the spending. So ultimately, I think the inflation figures will end up being more important than the falling gas prices. But the gas prices, if they come with falling inflation, will be exceedingly important.
Yeah, politics is rough and tumble. Jeb Bush used to say, it ain't beanbag, which is never a phrase I understood. It's like this old school, very conservative thing down south. Jeb Bush, like, politics ain't beanbag. Gotta have a thick skin. I feel like governor. What does that even mean? I don't understand the phrase, but I think it's largely it's rough and tumble for sure. It's not for the faint of heart. So I wonder overall, back to the markets here, Martin, I wonder if there is a silver lining as it pertains to the greenback and that's, of course, the strength of the U.S. dollar. There's certainly an impact on foreign exchange, foreign currencies. If you're a big multinational corporation right now and you do a lot of business abroad, maybe it's not necessarily a good thing overall that the dollar is where it is, but I wonder if there is room for any optimism given what we have seen out of the strength of the U.S. dollar compared to other currencies.
If there is a silver lining from that increase, it's the fact that imports will become less expensive for American consumers, and then you can hope that that cost will be passed down at the cash register. In other words, this economy, the consumer goods that it does consume heading into the holiday season are very often brought from markets overseas, and the U.S. dollar is going to make them slightly more attractive on a price basis as a result. So if we are looking for ways to stoke consumer demand heading into October, November, and December, a strong U.S. dollar is a great way to do it. But it's an unnerving strength, JD, as opposed to one that's indicative of underlying economic strength. And I think that's what worries investors right now. The US dollar index, it really is a great one to watch. DXY is the code. It tracks the US dollar against a basket of 6 global currency pairs, the biggest 6 in the world. It's trading at a fresh 20-year high this morning of just over 112 points, and it's up about, if I have the figures right, 15% so far this year. It's one of the best gains in about 2 decades, as you might imagine. That is, of course, a blunt on overseas revenues for S&P 500 companies, and about 40% of revenues are overseas generated for the S&P 500. So not great for earnings, but probably, again, if we're searching for that silver lining, relatively solid news for the U.S. consumer.
Yeah, the answers are always far more nuanced than the simple headline would otherwise suggest, so I appreciate the perspective there.
Well, it's
I do want to talk about
JD,
Goldman.
Can I jump in? I want to jump in just with one point, because you raised a really, really, really important point that I think is worth emphasizing. Ultimately, everything in financial markets and everything in the world that's associated with anything that we count is what we call double-sided. In other words, for every asset, there is a liability. If we go back to our accounting 101, you can't have one column out of balance with the other. They all have to come together at the end in order to have the proper symmetry. So I think what you say is actually really profound in the sense that it helps us understand what's going on in financial markets. For every action, there is a reaction. For every asset, there is a liability. Nothing in global financial markets moves in isolation. There is always a mirror impact in the other direction.
Martin, thank you. I'll be honest with you. I was not trying to be so deep and profound, but if you're going to give me, listen, as we said earlier, it's a short porch for me sometimes to hit a home run. I didn't, I wasn't going. I was just trying to get a simple base knock to get on base, but I appreciate the shout out. No, but it is very. It
a long ball. So.
Yeah, listen, I appreciate it. It is a really good perspective. I think it's important for viewers and readers of your stories and everything we cover at TheStreet.com to keep in mind, because it's very easy to get sort of caught up in one individual data point, one individual headline. We often have an overreaction, both on an individual investor level, as well as we saw earlier this week. We've been talking about this. Is there a big overreaction to a comment from the Fed chair, this and that? So thank you for the perspective. Perspective and context always helps everyone become a little smarter as we go through this together. I do want to get your perspective here on Goldman. I hit the trading floor this morning, and this was one of the things I heard traders talk about the most in the last hour and a half. So here at the New York Stock Exchange, Goldman Sachs has cut its full-year target for the S&P. Martin, where do they see it going?
3,600, I think, was the number I saw this morning, JD, although I wasn't as deep into it as I would like to have been, simply because I didn't see the note myself. But its headlines and a couple of sort of nuggets did come through. What was interesting to me was that not only did they cut their price target for the benchmark, but they also said it could actually fall further if the Fed were to miss that soft landing target. And I think what we're seeing now, more so in bonds than we are in stocks, at least today, is that we're very unlikely to meet that soft landing. And quite frankly, the Fed chairman said as much on Wednesday when he said that their inflation fight was going to cause certainly a downturn in the economy, which he couldn't define just yet, and he wasn't sure how long it would last once it did. So I think soft landing is out the window just now. Hard landing is almost a certainty. It's only a matter of depth as opposed to time. And therefore, it doesn't make any surprise that Goldman's going to cut the price target for the S&P 500 as a result, because we're going to see earnings decline in the final months of the year and then forecast declines going into 2023.
Yeah, brace for impact here, perhaps. You are exactly right, by the way. That new target there at 3,600 points. That is a cut of about 16% with regards to its year-end 2022 target for the benchmark S&P 500. An important story, excuse me, that, as we said, has been talked about heavily here on the floor today. I feel like we may be coming back to that one in the days and weeks ahead, Martin. Okay, let's move over onto something else that is cool, because you and I are both big sports fans and we love talking about this stuff, but there is also a very real, a very flashy tech company component to this next story, and it's going to be of interest to everybody, whether or not you're a football fan come February. And that's, of course, Pepsi. Move on over. Apple Music, the new sponsor of the Super Bowl halftime show. What do we know about that deal, Martin?
This is really interesting in a number of different ways, JD, but the news came out last night that Apple Music is going to be the sponsor of that Super Bowl halftime show. They're going to begin a 5-year deal that will cost reportedly around $250 million, and it will begin at the Super Bowl in Glendale, Arizona in February of 2023. It's interesting in that Pepsi has decided to give up its 10-year deal to sponsor the event, which, it has to be remembered, is the most watched television program every single year in the United States and drew 120 million viewers last year. It's also interesting in the sense that Apple doesn't do a great deal of marketing. This isn't something that comes naturally to them. They have always felt that the sort of the broader advertisement of their products and the, let's be honest, the glowing reception that they receive in the media is more than enough to compensate for marketing and price cuts and discounts and other things. So this is an interesting turnabout in terms of their broader strategy. And it was interesting that they decided to do it with Apple Music, because, as we've talked about on many occasions, JD, Music, which is embedded into the services portion of the Apple operations, is the fastest growing of all of the company's components. Is faster growing than iPhone sales, than iMacs and accessories and all those other things. Services, Apple Pay, Apple Music, Apple Media, all those other things are growing at a much better rate, because obviously you have what's called an installed base. There's a bit more than 1.2 billion iPhones and other Mac devices out in the marketplace. When people don't upgrade, Apple doesn't stop generating cash from them. It keeps them in the ecosystem and keeps generating cash through the services revenue. So using music to further lever the brand development of Apple services is really important. And the fact that they're doing it with the Super Bowl halftime show is interesting as well.
One more quick one on this, because Apple's, of course, in the conversation looking to compete for the hallowed prize of NFL Sunday tickets. I love NFL Sunday ticket. I used to live in Washington, D.C., but to watch my beloved football Giants, I needed NFL Sunday ticket. So what's amazing to me is now you've got this component where Apple and Amazon have somehow now firmly planted themselves within the product of professional football. How did we get here, and is this the future here in terms of being a football fan? It's you take these legacy tech companies, and now within a few years, they'll be running the show for a product as big as the NFL.
It really seems to be, JD. There's nothing more immediate. Well, maybe financial markets would argue a little bit, but there's nothing more immediate than sports rights, because it's really the only thing that people need to watch at the moment. They can't record it. They're not going to DVR it. They're not going to watch it later today. They're not going to binge it. They're going to watch it at the moment, and that is an advertiser's dream, because there's little else left in the media landscape that commands that kind of attention. So big tech wants to get into sports in a big way, and I think that Apple maybe have stolen a march on some of its rivals in trying to get those Sunday ticket broadcasting rights. DirecTV has had it for the past, I think, 10 or 20 years. That contract expires at the end of this season. So next season, Sunday ticket is going to go to someone else. As we understand it through reporting, DirecTV is balking at the idea of paying the $2.5 billion or so that it will cost. And we know that companies like Apple, like Amazon, like Google have the cash to do so. And we know that Amazon has dipped its toe in the water of broadcasting with Thursday Night Football, which has been a tremendous success for them. They actually have viewership that's double the NFL networks from last year. We know that they want to get into it. Apple seems to have elbowed its way in with respect to the Super Bowl halftime sponsorship. So there could be a bit of a bidding war for that when we look into the next year. And ultimately the NFL's decision on the Sunday package.
Absolutely. Amazon's also benefiting, which is smart from the league perspective, to build a new brand. You give it really competitive games. So, I mean, right, you put Buffalo in the first week. You bring in names like Al Michaels, Kirk Herbstreit. And so that's a smart way to build the product. It's not like I remember originally NFL Network would carry the Thursday night games. You'd be like, Jacksonville and who we're playing? Why? You know what I mean? But now I think the calculus has changed. They put high profile games in those slots. They change consumers' behavior to now tune into Amazon Prime for a football game, much in the same way Apple and Amazon change our consumer behavior with every new update, and it's all related. Okay, time now for our rapid fire section because we are running out of time because that's how good our conversation is today, Martin. First off, let's talk this. How is Costco faring amid sky-high inflation?
They're doing okay. They had stronger than expected earnings. They beat on the top and the bottom line, and I think that was a bit of a surprise to some investors. What they didn't do, however, was increase their profitability, and that just indicates the high watermark that investors have for a company that's just done so well over the past 5 to 7 years in a difficult consumer landscape. So we saw the share sell off in the overmarket last night and again this morning as a result of that. But it was interesting to me, JD, that the company executives are saying a couple of things. Firstly, they see inflation pressures abating in the coming months. And secondly, and probably most importantly, no plans to increase the membership cost and no plans to change the price of the hot dog soda combo. They say it's going to stay at $1.50. And the CFO actually told investors last night it's going to stay there forever.
All right, well, that will be welcome news for many Costco shoppers. Next up, let's head to the skies. Boeing facing yet another fine over its 737 MAX. What does it mean for the company, Martin?
I think they really want to get this 737 MAX out of the headlines once and for all. It's been such an overhang on the company since those two fatal crashes in 2018 and 2019, and rightly so. It took the lives of 346 passengers and crew and were just an absolute disaster on a number of levels, not only for the families of the victims, but the company and for airline travel in general. So the SEC last night said that Boeing agreed a $200 million fine as a result of some misleading statements about the aircraft safety after the first crash in 2018. And the former CEO, Dennis Muilenburg, was also agreed to pay $1 million in personal fines. Neither party admitted or denied the SEC's allegations, but they put it underneath them, hopefully once and for all. Boeing's already paid $2.5 billion in fines as a result of a DOJ investigation as well. They're trying to get the aircraft certified in all markets around the world. China is dragging its feet. That's going to be the most important ultimately. But I think more than anything else, Boeing would like to put this whole saga behind it. They have been apologetic. They have been attempting to try and fix the problems of the past and change the culture of their relationship with the FAA, even going so far as to moving to the suburbs of Washington, D.C. But this story still lingers, and many would say rightly so.
Absolutely. Let's head on to number 3 here for our rapid fire section. How bumpy, Martin, does the road get for FedEx? Interesting week.
I tell you what, it's been a really tough haul for the new CEO, Raj Subramanian, has only taken over a few months ago, and he's had to deliver a profit miss to investors, and he's had to try and articulate cost cuts to an investor base, which is growing increasingly skeptical about his early leadership. He is saying they're going to try to pare about $2.7 billion out of the cost base in the coming years, but he didn't provide really enough specifics last night during a conference call on the earnings that they, of course, pre-released earlier in the week. And of course, that triggered the biggest decline in the stock really in about 25 years. So there is a lot of questions about the company's ability to be profitable and to generate consistent profit growth when its revenues are rising, but its earnings are declining. That's the curiosity and the reason that people are more skeptical about the company's prospects. They're going to try to slim down some of its flight operations and really probably reduce headcount and trim some of the fat in an organization that has, obviously 220 different divisions around the world. But that's a tremendous task. And at the moment, investors just simply aren't convinced that the new CEO is the man to do it.
And finally, Martin, let me get your sense here as a big sports fan. I know you are. What are you more interested in for this coming weekend? Is it 99's pursuit of 61 in the Bronx or NFL Week 3?
What's amazing to me, JD, is the NFL just has such a hammerlock on American popular culture that it takes a record-breaking attempt from one of the greatest baseball players of our generation to garner even a little bit of attention on an NFL Sunday. Normally, there's nothing else that matters. But I think Aaron Judge's attempt to hit that 61st home run against their hated rival, which you know much better than I do, in the Boston Red Sox, will be an interesting sort of dichotomy to all the football that we're going to gorge ourselves on over the weekend, including, if I will be biased for myself, a really interesting game between my Miami Dolphins and the Buffalo Bills, the current Super Bowl favorites, the two hottest teams in the NFL, and dare I say the two hottest quarterbacks going head to head. That's going to be a fun one to watch.
It's going to be a fun one, as will the Yankee game tonight. It's Rich Hill on the mound for Boston. Garrett Cole, our number one, going for the Yankees. A little bit of disappointment in the Bronx the last couple of nights with Aaron Judge unable to hit that record-tying home run. I think maybe he does it this weekend. But you're right, NFL's like top dog. You know what I mean? Like come Sunday, it's like, all right, we know the baseball game's on, but I'll be there. I think I'll be tuned in and I'll be cheering for your Dolphins for an upset win over Buffalo.
You're a good man.
I don't even know if it's that much of an upset. Absolutely. Martin Baccardax, wonderful conversation today. I wish you and your beloved Dolphins the best for a wonderful weekend. Martin, thank you.
Thanks, JD.
You got it. That's going to do it for Opening Bell here from the floor of the New York Stock Exchange. Stick with TheStreet.com for more on these and every other major market story that mattered to you. We'll see you later.